Good evening, everyone. How are you all? Good evening. Okay, so today we are meeting to practice certain questions on the topic of cost of capital. We have covered this topic in our normal discussion earlier, and now we are going to use this session to practice a good number of questions based on the concepts that we have already discussed. So before we go ahead with the questions, let me just quickly recap all the formulae for cost of capital, and then we will take up questions based on that. So first up, we have discussed how to calculate the cost of debt. Well, this cost of debt is going to be by whether it is irredeemable or redeemable. If it is redeemable, then the formula is interest into 1 minus T plus RV minus NP by N, the whole divided by redemption value plus net proceeds by 2. That's the redeemable instrument cost of debt. If it is irredeemable, then the cost of debt is simply interest into 1 minus T upon net proceeds. Okay. Cost of preference share. Cost of preference share is similar to cost of debt formula, but there is a slight variation in it. Instead of interest, we take preference dividend. So this is preference dividend plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. And similarly, cost of preference share for irredeemable preference share is preference dividend upon net proceeds. Okay. Cost of equity, we have seen multiple formula. One of the formula is EPS upon MPS. Another formula is also equal to dividend per share upon MPS. Then dividend growth model, constant dividend growth model, cost of equity is calculated as D1 upon P0 plus G. D1 is the next year dividend or the upcoming year dividend. P0 is the current market price. And G stands for the growth rate. Okay. So these are like the cost of equity numbers. Then we have the formula to calculate growth is B into R, where B is the retention ratio, R is the return on equity. Okay, B is the retention ratio and R is the return on equity. The cost of equity, another formula which we had was the CAPM, which is RF plus beta into RM minus RF. So RF plus beta into RM minus RF, that's the cost of equity. Okay. Apart from that, we have also seen that KO, which is the overall cost of capital or weighted average cost of capital, KO. This is calculated as simply weight of equity into cost of equity plus weight of debt into cost of equity plus, cost of debt plus weight of preference share into cost of preference share. So it's just a weighted average of all these numbers. Okay. Apart from this, we have also discussed something like the way to calculate. We have seen the way to calculate also the cost of preference share and cost of debt using the YTM or the IRR method. Okay, YTM or the IRR method. So that we will also obviously take up in a subsequent discussion. But right now, we are going to do this initially question 1 and 2. I don't think we have done this questions in our class. We haven't done these 2 questions in our class. So let us first go ahead and try to solve this question number 1. Mag is asking, can you please explain practical problem 5 from study material? Yes, Mag, I'll do that. After we complete these 2 questions for the timing, then we'll go for the question which you are asking for. Okay. Now, let us, do we have the degree of leverages in syllabus? Yes, we have it in leverages, right? The chapter of leverages, which is not yet completed. That will be done in the next session. Okay. Now, the company issues, question number one, company issues 10 lakh 12% debentures of rupees 100 each. The debentures are redeemable after expiry of a period of 7 years. The company is in 35% tax bracket. The company is in, so company is in 35% tax bracket, and we have to compute the cost of debt, which is the after tax cost of debt. If the debentures are issued at par, 10% discount, 10% premium. And if brokerage is paid is 2%, then what will be the cost of debentures if it is issued at par? Okay, so let me just copy this question, and then I think we'll be able to solve it once I assign the values to it. Okay, so here we say that the face value is 100. In fact, your redemption value is also 100. Your time period is 7 years. Interest is 12. And tax is 0.35. In the first case, we are saying net proceeds. If it is issued at par, so net proceeds will be 100. In the second, in the first A case, this is the case. And then in the first B case, 10% discount. So net proceeds is 90. And first C case, net proceeds is 110. And in the second case, brokerage is paid at 2%. So of course, net proceeds will be after payment of brokerage, whatever is left out, which is 98. So for all these four scenarios, can we calculate the cost of debt, guys? Can we calculate the cost of debt using this formula? Using this formula. So I'll just write down the formula also here. So formula of cost of debt is interest into 1 minus T plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. Okay. Try to solve it, guys. Try to get the value of cost of debt. Okay. So 1A, the answer is 7.8%. 1B, it is 9.23. 1C, it is 6.37. And the second is 8.03%. Got it? Everyone? Yes. You will get it, everyone? Easy? Simple? In exam, how will you calculate? Same way. Just substitute. Like, for example, for the first case, you will say interest as 12 into 1 minus 0.35 plus redemption value is 100 minus net proceeds is 100 divided by 7, the whole divided by redemption value plus net proceeds by 2. Just have to solve it. Yes, you'll have to remember the formula, of course. And this is pretty simple formula. I don't think there is any manipulation or any sort of high funda logic you need for this. It is simple. Interest into 1 minus t, which is post-tax interest. Difference between what you pay today, what you get today, which is your net proceeds, and what you're going to get redeemed, which is redemption value. And then you just simply divide it by n. And then this will take the average. 1B is 9.71. Is it 1B at 10% discount? 9.71. Well, 1B should be what? 12 into 1 minus 0.35 plus redemption value is 100 minus 90 divided by 7. The whole divided by 100 plus 90 by 2. Okay. Now this formula is simple, but how can we interpret question? Of course, interpret question means what? You have to just take the cost of debt. Issued at par. Issued at par means, of course, the bonds are issued. The issue is basically net proceeds. And you have the face value. Face value generally going to the redemption value unless until they are specifying anything else. Number of years is 7. And 12% is the interest rate. So you can obviously take 12% of the face value, which is 12 as the interest amount. Okay, so just need to look at the question and identify the numbers. Pretty simple. Okay, so I'll go for the next question. Shall we go for the next question? Okay, let's take up this one now. I have this question number 2 is. I have the second question. Total 6 sub questions to it. So try to solve all of them. There are 6 sub questions. Setting the timer also so that you know exactly how much time you are going to take. Questions in totality should take you around 10 minutes.
So, first one, answer for the first one is you take 15% perpetual debenture. Wait, that side and then solve it. Okay. So KD is interest into 1 minus T upon net proceeds. So first one is going to be 150 into 1 minus 0.35 and perpetual, and it is sold at a premium of 10%. So 1100. So the answer for first one is that's 150 into 0.65 divided by 1100. 8.86%. Yes. Okay. Second one, 5% flotation cost. Second one is um, calculation wise, it's going to be 14 into 1 minus 0.35. So it's 2000 face value. This will be 280 rupees. So 280 into 1 minus 0.35 plus redemption value is 2000 with 5% flotation cost. So 1900 divided by 10, the whole divided by 2000 plus 1900 by 2. Yep. So the answer for second one, how much is it? 280 into 0.65, 182 plus 10 divided by 1950. 92 divided by 1950. This is 9.84. Yeah, 9.84. Then what about the third one? One, 10-year, 14% preference share of rupees 100 each. Okay, third one, 10-year, 14% preference shares. So this is going to be 280 plus redeemable at a premium of 5%. So redemption value, premium of 5% means 2100 with 5% flotation cost. So it's 1900 divided by 10, the whole divided by 2100 plus 1900 by 2. But wait, the question is saying that we have got dividend tax at 10%. So when it comes to dividend tax, it is going to be 1 plus dividend tax is 10%. So it's going to be 1 plus 10%. Face value is 100. Okay, face value is 100. Then these numbers are going to change. Yes. So if face value is 100, means this is going to be 14 into 105 minus 95. Because redeemable at 5% premium and 5% flotation cost. This is 105 plus 95. Yeah. Okay, so what's the answer for third one? Is preference dividend tax should be added because when it is the tax on dividend, the company has to pay from its own pocket. So along with dividend, the company is going to pay the dividend tax on it. So we need to add that. It's not an income tax that we are going to subtract. Okay. So what is this? Give me the answer. That's 14 into 1.1. That's 15.4. 15.4 plus 1 divided by 100. Yeah. 15.4 plus 1, 16.4 divided by 100. So that's 16.4%, right? The answer is 16.4% because this side you have 15.4 plus you have this as 1, then divided by 100. So 16.1. Yes, Anil, you're right. So income tax is a benefit of tax, unlike dividend tax, which is a cost which you need to pay to the government. If you're distributing dividend, you have to pay tax to the government. 15.4 calculation. So that's 14 into 1 plus 10%. 14 into 1.1. 14 into 1.1. That's 15.4. Simple. Okay, so that's third one. Now, fourth question. Okay, so now the fourth one. An equity share selling at rupees 50. So an equity share selling at rupees 50 and paying dividend of 6 per share, which is expected to continue indefinite. So equity share selling at 50, paying dividend at 6. So it is simply 6 upon 50, which is 12%. Simple. The above equity share dividend is expected to grow at a rate of 5%. So that will be 6 by 50 plus 0.05, which is 17%. Okay. Now the next one, an equity share is selling at 120 per share. So here we have the equity share selling at 120 per share. So P0 is 120. EPS is rupees 20. So EPS is 20 rupees, of which 50% is paid in dividend. Of course, dividend per share is 10. Shareholders expect the company to earn a constant. Okay, so there is an issue with this constant uh, rate of to earn a constant rate of 10% on its investment. So you have the return on equity as 10%. You have B as retention ratio. So retention is essentially EPS minus BPS. So this denotes the retention that we have. So it is 10 divided by 20, which is 50%. 50% is being paid up. Okay. So we have now the growth rate as B into R, which is 50% into 10%, that is 5%. Now we can get KE as D1 upon P0 plus G. So D1 is 10 into 1.05, which is 5%, divided by P0 is 120 plus growth rate of 0.05. So the cost of equity will be 10 into 1.05 divided by 120 plus 0.05 is 13.75%. In case 4, okay, case 4, above equity is expected to grow. Yeah, so this will be like 6 into 1.05, correct. This should be 6 into 1.05, yes. Next year dividend we need. So this will be obviously a different number. 6 into 1.05 divided by 50 plus 0.05 is 17.6. Yes, expected dividend, correct. Okay, fine. So that's the second thing which we are done. Now I think someone has asked a question from study material. Do we have that student right now? She, Mehak. Is there, Mehak? Yes. Okay. Now let me just come up with the study material. Practical question 5. Okay. Practical question 5. You're talking of this one, right? Yes. Okay. Determine the cost of capital of Best Drug Limited using the book value and market value. So I need to calculate first the individual cost of capital. Okay, so let me give you the guidance and then we can start the discussion for this. So equity shares are quoted at 130 per share and the new issue price is 125, which will be fully subscribed. Flotation cost will be 5. So over here, your P0, you have to take it as 120, which is after discounting for the issue price and the flotation cost. And D1, you'll have to calculate. Well, for D1, during the previous 5 years, dividend has consistently gone from 10.6 to 14.19. I think this type of things we have done in my lectures, right, others, students? How to calculate the growth rate by observation and also by looking at the first year and the recent year value. Right? So this is like in 5 years, it has grown from 10.6 to 14. Dividend at the end of the current year is expected to be 15. Okay, so we have the D1 as 15, but then I have to get the growth rate also. Now, growth rate, I can get it by simply taking 14.19 equal to 10.6 into 1 plus growth rate raised to 5. So using that, we can get the growth rate also, right? We can get this growth rate similar way. So you can get the growth rate by solving this equation. Okay. And this will be enough to calculate the K. Preference share is 15% preference shares with a face value would realize 105. So for this, We have the net proceeds is 105 and just the preference dividend is going to be 15. So it is irredeemable because they have not specified any time period. Then the company proposes to issue 11-year 15% debenture, but the yield to debentures on similar maturity and risk class is 16%. Flotation cost is 2%, and corporate tax rate is 6. Now, this is something, which is challenging. Both parties, bit challenging, but I hope we will be able to get the cost of equity and cost of preference share. Can we calculate the cost of equity and cost of preference share? Yes. So please go ahead and calculate that. Then I'll tell you how do we look at this cost of debentures. Just solve this cost of equity and cost of preference share, guys. Okay. So KE is how much? 18.5%. And KP is 14.28%. Now the important part is calculating the cost of debentures. So let me just help you with the calculation of debentures. This is something a bit different. So company proposes to issue 11-year 15% debentures. So we want to uh, issue a debenture which is having an interest of 15 rupees, assuming that the face value is 100. N is 11. Yield on debentures of similar maturity and risk class is 16%. Now, where they're saying yield on debentures of similar maturity. So I need to calculate what should be the selling price, or instead of saying selling price, I can say what should be the issue price. Now, issue price will be obviously, I will be calculating the value of debenture is simply present value of future cash flows. That is going to be 15 divided by 1.16 plus 15 divided by 1.16 square plus 15 divided by 1.16 cube, like this till you have 15 divided by 1.16 raised to 11, and also the face value which is 100 divided by 1.1611. So you just take the total of all of them, or you can also say it like this, that it should be 15 into present value annuity factor at 16% for 11 years plus 100 into present value factor at 16% for 11 years. So you just take the present value of all of them. That will give you the issue price of debentures. So tell me, what's the present value annuity factor at 16%? The present value annuity factor at 16%. Present value annuity factor at 16%. I have done how to calculate the present value in foundation. 1 divided by 1.16. And you just have to, like, you can get this by 1 divided by 1.16 equal to 11 times. And then press the button of GT. Yeah, so that's 15 into 5.028 plus 100 into, now this present value factor can be obtained as 1 divided by 1.16 equal to just 11 times. So before you press the GT, you will be getting this value. Tell me, what's the present value factor? The present value factor. Is it how much? 0.1954. And then give me the total. Why have we taken 16%? We have taken 16% because we have to issue this debenture at a competitive price. Of course, that competitive price should be decided by using 16% because that's the rate of return which the investors are asking for. So tell me what's the value of, what's the issue price number? How 0.1954? I've shown this 1 divided by 1.16. Just press on equal to 11 times. Okay, so 94.96 into 0. Okay, flotation cost is applied on issue price. Yes, today's flotation cost is 2%. You take it as a 2% of your net proceeds because whatever money you are receiving, out of that, of course, you're going to pay 2% as flotation cost. Alternatively, you can also write an assumption that we're going to take the 10% of its face, 2% of its face value also. That's also correct. And then you just get the net proceeds. You have the redemption value is 100. So redemption value 100. You have the net proceeds, you have the interest, and you just have to calculate the cost of debentures then. Let me just quickly look at this solution for fifth. Yeah, so this is what they have done, right? This is what we have calculated. I think there is some, okay, 94 point, this is what we got. And then, okay, you're taking 2% of the face value. That's okay. You can obviously take the 2% of face value, or of that, you can just write the assumption also. That is also fine. No worries about that. Okay, I think this is done. This is perfectly captured. And then after that, you have to calculate the weighted average cost of capital, which is pretty simple. Okay, fine. Okay. Uh, Try out this question 8 now, guys. Try out this question number 8. Okay. So here you have to calculate K. K is risk-free rate plus beta into RM minus RF. So RF is 7% plus beta is 1.2. RM minus RF is, well, this 6% is market risk premium, guys. 6% is a market risk premium. Okay, so this is going to be into RM minus RF. So that's going to be 6%. 7% plus 1.2 into 6%. So answer is how much? That's 14.2%. Yes. Okay, fine. That's 14.2%. Okay, so that is about question number 8. Will we have leverages session? Yes, Ananya, we have one more session of leverages. Probably it's on Wednesday, I suppose. Wednesday or Tuesday, I need to check. We do have it, okay? Okay, so that's question number 8. And now, okay, let's take a break now. After break, or 15 minutes break, and then we will do few more questions based on this. Do we need to write YTM formula? No, there's no need. You can do the same formula or method that we have used. Yes, definitely you can use. In fact, the formula that you see in the model is also the same thing, but it's just that they have formalized it in a better way. But to understand my method, that's perfectly fine if you do it. It's the same thing what you have. Yeah, it's the same, but it's a bit of structure. Generally, students find it difficult to remember those formulas, so I generally go for the logic based method. Okay, so let's take a break now, guys. We'll meet after the break. Let us continue with the next questions, next set of questions. Okay, try out this question number 5, everyone. No, not 5, not 5, wait, wait. We take up something else. Okay, try out this question number 7, everyone. Try out this question 7. So you should be able to do this within 12 minutes. Yeah. Okay. What is? cost can be computed by using the CAPM model, for which you have the risk premium number as 8%. So this is your RM minus RF. This is your RF, and that's your beta. Okay, that's for cost of equity. Now for cost of preference shares, sorry, cost of debentures are redeemable after 3 years. So this is your N, and are quoting it. This is your net proceeds. Applicable income tax rate is given. Uh, then preference shares and preference share. This is going to be the net proceeds. Anyways, from these values, you can get the amount of interest and preference dividend. And this is again interest for the term loan. This is your interest. Okay. I think you have to calculate using market value weights, and each of these instruments are having their own what do you say, market value weights. Market values are given. So debenture market value is given, preference share market value is given. Based on that, you have to calculate the market value and get the weighted average. Are we able to get the individual values? Everyone? Are we able to just complete it? Okay. So what's the answer for K? What's the answer for K? How much is cost of equity, guys? 15%. Yep. Just do one thing. Try to put the solution in front of you directly. Okay, this is supposed to be the answer. Yeah. Just check. You're getting cost of equity 15%, cost of debt uh it is 6.87, cost of preference share 10.97, and cost of debt for term loan is 5.53%. Just verify this, guys. Except term loan. So term loan 5.53. How much are you getting then? Okay, now you're getting it. So just check the weighted average cost of capital also. You have the weighted average cost of capital and also the second part. You're getting the second part also. At the time of weight calculation, no, we don't take reserve because when you're calculating weightage using market value, you don't take the weights into consideration. Marginal cost of capital. Well, marginal cost of capital is the cost of capital for uh, extra money that you're raising. So extra money that we are raising is 750. Extra money that we are raising is 750, and they're saying that debt is going to be 20% of that. So debt is 20% of 750, which is 150, and equity is 600. That is 20% of 750, which is 150, and equity is going to be 600. Beta is 1.4375. So you have the total capital required 750. Debt is 20% of 750, which is 150. Equity is 600, right? The balancing, and beta is already given 1.4375. Based on that new beta, you calculate the new KE. And interest rate also, they have said that up to 100 crores, it's going to be 9.5%. And any amount you borrow above that, that's going to be 10%. So we are just taking the weighted average number over here. So 100 into 9.5% plus 50 into 10%, right? So that gives you the amount of interest as 14.5. And that 14.5 is used to calculate the cost of debt. Marginal is nothing but additional money which you want, additional money which you are raising. What is the cost for that? Okay. Okay. Fine. So that is the seventh. Now let's try to do this question number 6, guys. So we have to calculate here the weighted average marginal cost of capital. You're raising 10 crores, given the following information, the amount will be raised by equity and debt in equal proportion. So basically 10 crores is going to be raised 5 crores as equity, 5 crores as debt. Now out of that equity, 1.5 crore is already that you are having as earnings. So what will be the new fresh equity that we are going to issue? Fresh equity that we are going to issue. Fresh equity will be 3.5 crores. You already have a reserves of 1.5 crores and you need to raise a debt of 5 crore. So first you need to calculate the cost of equity. So for cost of equity, you have this price, you have the D1 and the growth rate in dividend. Of course, that will give you K, and debt interest needs to be computed. So here the formula will be interest into 1 minus T upon 5 crores. So you need to compute the interest. Now interest will be computed as what? 15% of 2.5 crores and 16% of the other 2.5 crores, because total debt is 5 crores. And then you have to take the weighted average. Got it? Yeah. So just try to solve it now. Okay, so what is the cost of equity? We have the D1 as 3.6, P0 is 32, growth is 7%. KE will be D1 upon P0 plus G. So D1 is 3.6 upon P0 is 32 plus growth is 0.07. Yeah. So what's the value? 3.6 divided by 32 plus 0.18.25%. Okay. Now, cost of debt. For cost of debt, we need to first get the value of interest. Interest will be 15% of 2.5 crores plus 16% of 2.5 crores. So interest is 2.5 crores into 15%, 0.375 plus 5 into 16%. So that's 0.775. Cost of debt will be 0.775 into 1 minus 0.4 on 5. 0.775 6 divided by 5. 9.3%. Okay. So weighted average cost of capital will be half because 50% is the equity weightage. So half into 18.25% plus half into 9.3%. What's the weighted average cost of capital? Here is what? 13.78%. Okay. Here we take reserve. Here we are taking reserve because we are not using the market value weights, right? Mac, we aren't taking the market value reserve. So obviously we'll take the reserves into this. Okay, got it? Ananya, yes, I will do that. Ananya, don't worry. If market value given, then we don't take reserve. Of course, then you will take the market value of shares, right? And when we say market value of shares, it includes, when you take market value of shares, it includes the market value of reserves also. Therefore, you don't take it explicitly in a separate manner. Okay. Now, let us go for okay, question 14th. Where this question number 14th? Where this question 14? So here we have this as EPS as 4 rupee. Dividend payout is 25%. We get the amount of dividend. T0 is 25%. So 4 into 25%, which is rupees 1. Then the growth rate will be B into R. In fact, growth rate is given as 8%. So we can get the D1, right? So D1 will be 1.08. T0 is 40. We can get the cost of equity. Cost of equity is D1 upon P0 plus G. So D1 is 1.08 divided by 40 plus growth rate is 0.08. 1.08 divided by 40 plus 0.08. So that's 1.08 divided by 40 plus 0.08, which is 10.7%. Right? A is 10.7%. Earnings per share is given as 4. So of course, if this is the earnings per share, we are saying it is prevailing to the current earnings per share. Okay. Now, cost of debt is 10% up to 2 lakh and 15% beyond that. So we need to first calculate the amount of interest. Interest will be 2 lakh into 10% plus another 2 lakh into 15%. So if you just add them together, it is 20,000 plus 30,000, which is 50,000. So cost of debt will be interest into 1 minus T upon net proceeds. So interest is 50,000 into 1 minus T is 30%. So interest into 1 minus 0.3 divided by net proceeds. So net proceeds is 4 lakh. 50,000 into zero point 0.7 divided by 4 lakh is 8.75%. If the question says that the earnings is for the next year or dividend for the next year or next expected dividend is so and so, then you have to take D1. Otherwise, you can take it as D0. Okay, so we have the cost of debt, we have the cost of equity, and then finally the weighted average cost. So weighted average cost KO will be weight of equity into cost of equity plus weight of debt into cost of debt. So weight of equity is zero point 0.6 because out of 10 lakh, 4 lakh is debt. So of course the rest 6 lakh is your equity. So zero point 0.6 into cost of equity is 10.7% plus zero point 0.4 into 8.75%. Just add them. 10.7 into 0 0.6, which is 6.42 plus 8.75 into 0 0.4, which is 3.5. So weighted average cost is 9.92. Weighted average cost is 9.92%. Did you get it? Did you get the overall cost of capital? 9.92%, everyone? Yes. Okay. Okay, so with that, we'll just uh, stop here for the revision session. These type of questions are, yes, modules. You can refer the module also, you can refer RTP, MTP also. If we take this as D1 and right, assumed in the next year period, will it be okay? Yes, that will be fine, Ananya. Okay, but yes, remember if the question says that a present dividend is so and so, then you can't take it as D1 as assumption. Okay, fine. Let's just stop here for the day, guys. See you in the uh, next session. Upload the answers. Yes, answers are in the Excel format. I will upload it in the portal. Okay, fine. Let's just stop here, guys. Notes are done. I think only leverages is done pending. Leverages, I will just upload it. Okay, so with that, let's just stop here for the day. See you in the next class, guys. Bye bye.